Seems to me, mate. It seems to me that we might be live on Facebook.
Excellent.
How are you going? Hey, mate. Cheers. You see,
Cheers,
you're
mate.
on the Champers today.
Mate, I am. I'm going to give this one a little bit of a plug because
give it a plug.
I
We'll
love.
see if we've got a few people online. We'll see how we go, mate. Probably good to give who's the maker.
It's local to Victoria, and I had this. Magda once took me out to a beautiful restaurant for my birthday, and it was one of those degustation type things where they matched the wine and each course. And I always remembered the label of it, and I got no affiliation with it, but I always remembered the label. And I saw it when I was in Dan Murphy's the other day, and it's actually from the Yarra Valley. It's Ali Bank is the name of it, and it's got like a dragonfly on it, and it's from Punt Road Winery. But mate, for $20, this drink's like 120 bottle of champagne. It really does. It's quite incredible.
But I think we should always kick off the live with you reviewing a wine. But for everyone who's dialing in, welcome. If you haven't sort of met us before, Andy Fenton, Jason Witten. Positive Real Estate's not my real name. That's my business name down at the bottom there. So. Hey, listen, property investor for 20 years, coaching Australians and New Zealanders in property investing. Andy Fenton, banking and finance, 20 plus years. How old are you, Andy? 32 or something like that? Or
Mate, I reckon just a little bit past 40, mate. So I think I put the one after it. So,
awesome.
Kicking on.
Yeah. Well, welcome along, ladies and gents. If anyone's here today for the Wine and Wisdom session, like we've said a few times, this is Andy and I's weekly debrief. We've been good friends and compadres. We met about 4 years ago doing a program called K2 Elite with Kerwin Ray, and we've been great mates ever since. And we thought it'd be nice to sort of have conversations from our two versions of the world each end of the week, and maybe do a debrief. We're calling it Wine and Wisdom, and more wine than wisdom maybe, but let's see from our expertise. But mate, what's been going on in the world of finance, the world of the share market? What's the week brought for you and your neck of the woods, mate?
Mate, I reckon next week we will do a really big deep dive into it, and I'll have a whole lot of stuff prepared. But just to share with you and anybody else who listens. So it's been kind of an exciting week. And so the theme we said Wine and Wisdom, initially we were filtering down information, and the purpose of this was to get information to everybody, the real information. And so we've gone through the stimulus packages. You know, we've talked a lot about helping people decipher information, but there's just so much negativity now out there because the press of now don't have a huge amount to talk about. So they're just getting more and more sensationalist and more negative. So it's even more important now to listen to the right sources. So that we decided based on that, if you remember last week, I reckon I'd probably had a little bit too much to drink by the end of it, but we decided to go for opportunities this week and talk about opportunities. So, in that vein, I thought, well, I'm just going to put on my opportunities glasses and look at the market for what it is. And mate, it's amazing when you change the lens of which you look into the world for a week. And I've been very conscious, like in the mornings, it's very factual for me, do the exercise, consume the information. But for me, I was a big believer in the 6 thinking caps by Edward de Bono. And it tells you to when you view a problem, an issue or a challenge, you put on a different hat at each point in time and you isolate that view. You're only allowed to think about facts when you've got the white hat on. So in thinking about opportunities, I'm whacking the opportunities hat on, and then some great stuff started to come out. I'd love to start off with a bit of a story, because you were over in LA with us when we went over there on a business trip. And one thing that was really taking off in LA were these mobile scooters. Remember down in Venice Beach, you could go along
the line,
scan the QR code. Right? Scan the QR code. And Mark Camerari and I had tried to get from Venice Beach down to downtown LA by swapping scooters as the batteries ran out. So Really, really interesting because we've talked a little bit about mergers and acquisitions. So this is in the vein of mergers and acquisitions. So for those of you who don't know, Lime is an American company that they basically have scooters that are out everywhere. They're just on the footpaths. They spend 24/7 on there. They're electric scooters, and you can go along with your phone. You can take a QR code, and then you upload your credit card details, and however many minutes you use it for, you pay for the scooter for that period of time. And then when you're done, you just get off it and you leave it wherever it is. And then people can take that scooter into their house and charge that scooter, and then they get paid by the company, right, for charging the scooter, which is a great way of, it's really smart, right? So one of the great deals that I've been hearing about more recently is the I think he was the GM of Uber, and or is the ops manager or something like that, is now the CEO of Lime. And Uber has actually put $170 million investment into Lime. So this company that is all about this mobile technology. And so it's really interesting because Uber has been hemorrhaging from the side of ride sharing, has blown up in a good way from Uber Eats, and it's diversifying its capital. And so it's got a lot of investment capital there. It's got a lot of cash that it's sitting on. So it's deploying it into that downstream value add, into this sort of, I've forgotten what they call it, but it's actually got a name now, this sort of mobile micro transport. And if you start to future gaze a little bit, you go electric cars, you go automated cars, you go not allowed, or even look into England, right, at the moment. So England, there's a combustion charge. So if you take your car into the city, you get charged a lot more just by being in there because of the amount of fumes that go into the air. So now, fast forward to here, the coronavirus, people are not wanting to get into cars with other people. So they're trying to figure out autonomous transport in which they can basically not be in the same 4 square meters of each other. So what we're seeing is these sorts of people are getting thrust into these technologies. And so this creates a massive opportunity. And obviously Uber's seen this opportunity sitting on the horizon. And I thought it was an interesting one to start off with, because if Australia's a little bit different because we're so spread out, but if you were living in New York, and New York, by the way, have actually changed the laws about scooters and bikes as a result of this. So have Singapore. So have there were 2 other countries, two other countries who have changed laws, and major metropolises like New York that have actually changed the laws in order to be able to facilitate this, because just from a population density perspective, they understand that the cities can't handle this. And then you fast forward a little bit further down the track and you think about people now maybe needing to come in and out of offices more frequently because they're not necessarily 9 to 5 every day in the office. So there may be this whole new way of transport or modalities. Imagine sort of driving up to Richmond, dumping the car in a massive car park that's on the outskirts of the city, and then just jumping on your Lime and then scooting in and around the city to wherever you needed to be. So this is the M&A side of the equation. And we talked about it a little bit with Virgin, but these opportunities are really, really exciting. And we're starting to see a lot of them come. And so I've seen 4 or 5, which I'll bring with a lot more detail next week. But I guess that sort of theme is that when we start to look for those opportunities as well, because when you put on your opportunities cap, you start to look at, well, this corona will end, or it'll morph, or it'll do whatever. But this round, most likely, will end at some point in time. So then when you look over the horizon to where we're going, like if you have a look, so the banks have actually come out and released all of their information now. Really interesting to see, and we talked about it before, is Macquarie Bank is one of the few that actually kicked. So they released their half-yearly reports, and they're up about 5% after. So they were more disappointing than what was expected. But because of in my view, I believe one of the reasons why they kicked is because of their involvement in this mergers and acquisition space. So I think that's
they've always had a history of aggressive mergers and acquisitions in their DNA, right?
Absolutely. That's what they've done. They're the big chameleon, I guess, of the industry. So, being able to buy Macquarie as at this morning at $98 and now it's at 100 and something, it's certainly about 5% up, was a bit of a bargain. And it may go back down and it may come back up, but you would imagine that as things start to normalize over time, that we're going to be able to jump on that ride. And to put it in perspective, so if we just go through the major banks, we've got Commonwealth Bank from top $99, currently at $59. You've got Macquarie that's at a top in the last period of time, 6 months or so, $151. Now that got down to $72, but has been trading in and around the 90s. And you've had the ASX up as far as 7,100 and it dropped as low as sort of 4,500. Now is teetering around the 5,000, 5,300 sort of mark. So we've got, it's very, very hard to pick the bottom in these things, and the beauty about markets is that they are volatile. And that can also be the bugger about them. But I reckon you've got to start to put that opportunities cap on and start to take little nibbles at some of these, opportunities as they come by, because the reality is the banks will be supported by the Australian government or by ostensibly by printing money. And when we have a look at our debt to GDP ratio, and I'm not sure if I had these figures last week, Australia's sitting at about 20%. America's sitting at 80%. Japan is sitting at 160%. So that's 100% and 60% of debt to GDP. So what the country produces, right, if we put it in very, very simple terms, in Japan, for every $100 that they produce, they have $160 worth of debt. In Australia, for every $100 we produce, we've now got $20 worth of debt. And in America, for every $100, they've got $80 worth of debt. So in Australia, even though we can't see over the horizon of how borders are going to reopen and all of these sorts of things, when we start to look at Australia as an economy, they're forecasting 10% unemployment here. Now, in comparison to the rest of the world, that is extraordinary. They're forecasting 20 and above US and starting to realize those sorts of numbers. So I think that we need to, at least once or twice a week, start to put on our opportunity cap and say, as investors, all right, if I was conservative going into this and I'm young enough and I can take risks, do I now start to ask questions about more specific stocks and or jumping back into the market? And the one thing that I'm very aware of, and this is a personal belief, is I think that in periods of time like now, selection is super, super important. And you always talk about it from property perspective, right? The right properties in the right place. But any dickhead could have picked the property market while it was booming, right? You could get a shoebox and it was going to go up.
Everyone thinks they're amazing in the up times, but then, the real testament is when the tough times come along, for sure. Yeah. And
so if you think about that from a stock market perspective, where do you invest your money? You invest it in cash. You get no return for it. You invest in property. You've got to have a lot of cash or leverage to do it because it's a big asset. The flight to quality, which is, I think, an overused sort of term, but I honestly think that very, very soon we're going to see that. As this volatility and uncertainty unravels, we will see flight to quality. And my point here is that if people are just in index funds, well, what happens is an index, say the ASX 200, yes, it's very, very cheap to acquire it. Super, super cheap. But you get the top 200, the good, the bad, and the ugly. And the top 200 is only based on what's called the market capitalization. So the number one company is the largest, biggest company on assets and revenue, right? And that then goes down until you get to the 200th, which is, out of the top 200, it is the lowest revenue and capital. That's basically what makes up the index. It's not the best companies. It's just via market capitalization. So you're going to see a lot that go falling through that and down the bottom, and a number that will rise up. Now, they won't necessarily, counteract each other within the index. So this flight to quality is something that I think that you're going to start to see, in that people will look for quality stocks, and then people will take punts. So look for quality stocks and hold fewer in more concentration in sort of the top 200 in Australia and the top 500 in the US. And then they're going to look for the Limes of the world, and they're going to look for these smaller up and coming trends, because this is the exciting part, which, I'm still doing a lot of reading about it. But in normal times, when markets are just kicking along, innovation doesn't happen. You know what I mean? Like, people become complacent.
Why innovate? We're doing fine, right? Don't fix anything that's not broken type of idea, right?
And that, it's almost a human dynamic. Let's just keep making money over here because it's easy to make. Oh, we could do it better. Yeah, but let's just make more over here. But in times like this, people are innovating and pivoting really, really quickly. And so what you're going to see is not just mergers and acquisitions of companies that fail or need cash. Like Lime needed cash, otherwise it was going to go broke, right? And Uber came along and injected 150K into it, and will obviously be some form of strategic relationship that they'll have as a result of that. But there's also going to be these companies that get VC deals that are smaller companies that will become big companies, which will become semi-giants of the future, or even acquired by the giants of the future, because they've had to innovate. And I honestly think that's
what we experienced the other day, right? Where we listened to Vern Harnish. I don't know if everyone's into this stuff, but amazing book, Vern Harnish, cool dude. And he was talking about, like, people are raising capital like crazy people right now for deals, like this, right?
Well, then, so the interesting part was Buffett actually came out publicly and said that the world was too optimistic. Now, that's always it's always it's a bit interesting. I don't know. We'll see how that one plays out. People listen to him a lot, but in Vaughan's kind of space of that scaling up, you're going to see people who are going to learn how to build companies on shoestrings, and then have access to almost untapped capital. And the reality was, many managers, it wasn't just our business and my belief and we were conservative, but fund managers around the world were sitting on so much cash. We had John Abrahams from Partners Group Global, which is a global private equity firm, one of the largest in the world, right out of Switzerland. And they shut down their raising capacities because they just didn't see stuff that they wanted to investors' funds into anymore. And they were sitting on 15, 20% cash or something like that, and then couldn't deploy it. And the job of a private equity firm is to put the cash to work. But they couldn't see any opportunities in the market that were good enough. Now is a completely different story. You've got opportunities that arise through stress, which is, and in his illustration, he was saying that some of the industry funds, because of the superannuation release, are now having to increase their liquidity. And as a result, they're having to sell really good private equity assets that are normally illiquid. And because otherwise they'll breach. They're only allowed to have 5% in private equity mandated into their investment, right? If they breach it, they're in big trouble. So as people draw money out and that piece becomes bigger, then they have to sell it to the market. And there's only these sorts of companies that have the cash to buy it. So there's the forced sale, or the companies that are really, really struggling. But there's also the micro caps and the micro companies that are really coming up through the ranks. And so I think it's going to be really interesting. I still need to do a lot of research on it, but I think that this.
But you'd be you've been, call it close to 25, 30 years, in these spaces. I mean, other than places like, Japan and others, I mean, the cash, the return on cash, like, putting cash somewhere has never been worse.
Yeah.
So, think about it now. I mean, our population, certainly in Australia, is aging, around the world it's aging. all of these people, and you're in this space, you help people, you know, a generalization, but a lot of the people you help making sure their money works well for them are in their sort of 45s and onwards, right? You know, and certainly some of the specialties you have as in, you know, 50, 60 and above, you know, making sure that that money's deployed in safe, you know, sensible places, you know, but far out, you know, what's cash worth now? It's not worth nothing. Like, arguably there must be more cash than we've ever seen looking for deals, like in our entire history, you know. Well, yours and mine anyway, we're not that old, but you know what I mean.
And it will be put to work.
Yeah.
I fundamentally believe it will be put to work because of the superannuation funds of the world and things of that nature. People need their money to work for them, right? So we're going to start to see, in my opinion, and we've seen it happen before. I've always say that history doesn't repeat itself, but it's an incredible mimic.
Yeah.
And I think that that's exactly what we're going to see. We're going to see history repeat that flight to not necessarily just security, but that flight to good quality assets, but that also that ability to then go, okay, well, let's be more selective with what we're getting, because we're not just going to be on an upward trend. Let's be selective over here, and let's be selective on the smaller micro side of the equation. Yeah. And I honestly believe that the fund management money is going to start to flow into that, because the big fund managers of the world are not just putting it into indexes, right? They're looking for special investments to actually put them into. And as they start to identify them, you're going to start to see some extraordinary movement. And
I've always been fascinated in this space, like, you know, in your history, and I know some of the stories you told me about, you know, your days in banking and deals you put together and stuff like that. You know, if anyone's listening in and going, gee, I'd love to sort of put together something to see if I could rattle a tin and, you know, get somebody interested. At what level do those big players play at? Like, it's not like $1 million or $2 million. Like, what's the number? Like, just, you know?
Well, Russell, I think, has a fund that it's $1 trillion in size, as an example.
Yeah.
Now that's obviously, you know, massive diversification. Or sorry, their portfolio, I think, is about $1 trillion in size. So they're massive. But most of them, you're talking in billions of dollars and above. Like in Australia, it's hard. If you're close to $1 billion in Australia managing Australian equities only, that's tough because our market's not big enough. When you've got $1 billion, you're starting to take significant weightings in stocks.
Yeah.
Much like the indexes, and that's why we see when people sell out of these things, we see these big market movements. But yeah, no, the sort of companies that we were with, you know, tens of billions, 100 billion. That sort of space, you know.
And what sort of level would they entertain as a deal? Like, you know, so if you know, Jim and Mary were trying to put together some significant deal and they were on the VC, waving a VC flag or looking for funding or whatever, like they're not looking for like, they won't deploy capital for $100,000 or $1 million, right? Like it's
too much work. It's too much work. You've got more, that's more micro lending, and you do get some angel investing in that sort of space. You know, we don't play there. It's too volatile, and so when you're talking about private funding, it could be, you know, 8% through to 12% and above. And it's good to be on potentially the borrowing side of that, because you can get really good return and get good collateral for the return these days as well. Which means that your risk profile is lowered. But no, like typically you can't get in at those sorts of levels with these things. You've got to get in by unitized funds somehow in order to be able to get exposure to those sorts of deals. And then you're going to be exposed to a pool of, you know, $500 million worth of deployed capital in that space. But everything's been repriced, you know, and that's another one. Private equity funds like Partners Group, and I'm not suggesting people go and get that, but using it as an example, their whole portfolio has been revalued on cash flow of business, right? So and this is with COVID, and I think they were down 10% or something for the year, or 10% from the peak to trough. But with that revaluation in private equity, you're now looking at an opportunity to buy forward cash flows that have been discounted to current COVID times, with an expectation that COVID will last for another 3 to 6 months. and have those impacts. So you're able to get in on reprice dynamics. And yes, we never really know what's over the horizon. But the one thing that does always happen is that markets find a way, we find a way. And if we don't, well, currency is not going to be important anyway, unless you've got gold guns or what is it, gold guns or whatever the other one is. You're gonna be off anyway. So I think people need to start putting that opportunity hat on and start getting in. And Malcolm Palmer actually said it really well the other day. Is he said when markets are really bearish, he puts on his optimistic hat, and when markets are really bullish, he puts on his pessimistic cap. And he says it's so much easier just as a default position, not becoming the bear, but putting on the more pessimistic hat, being a little bit more pragmatic when markets are really good, and being a lot more optimistic when markets are bad. And he sort of says that helps him, firstly, from a psychology perspective as an investment manager, because he's not down there with everyone else going, oh my God, we're cactus. It allows him to be centered emotionally and start to look pragmatically for the opportunities rather than thinking about the potential losses. And as a market psychology, that stuff has been bandied around a lot with Buffett quotes, but it's hard to do. But it's something that I think that people need to be looking at and
need to be at, mate. I mean, I'm reading a book now, but recommended by you, mate. What's it called? Not Good to Great. The other one.
Great by Choice.
Great by Choice.
Tim Collins.
Fantastic. 20 Mile March. Yeah.
Yeah, exactly.
20 Mile March. Whether the weather's blue sky or it's a bloody storm, this is the 20 Mile March. Each day we do 20 miles. We don't do any more. We don't do any less. 20 Mile March. And for me as an investor, the psychology, I remember reading Robert Kiyosaki's book, Rich Dad, Poor Dad, and he was like, investing's, 20%, stuff and 80% psychology. And I was like, shut up, Robert. Give me the bloody, bullshit, stop trying to make me buy your course and stuff, you bloody bastard, but really at the end of the day, it's so true. If you don't behave the same way in a storm as you do in a calm day, your progression is volatile like the market, and so, I love that.
Yeah. And I've never used that analogy for investing, but it's a great one. It's like, if it's a really tough terrain, so the 20 Mile March, they're trying to cover 20 miles every day, but the theory behind it is they basically march by at X amount of pace. And their goal is to get to the 20 miles between their march time in the morning and sunset at night. So they've got to build camps. And there's a part in there where he does talk about there are periods of times where they didn't do 20 miles because they're going up something like this, and it was just not possible. So they pushed a little bit further. But when you bring that extra dynamic into it, that's exactly what it's like as an investor. Because if you want to be in stocks, like right now is a great point in time where if you go, I've got 100K, you just start nibbling.
Yeah.
A couple of grand here, a couple of grand there, and you pick your ones and you just take little nibbles.
I suppose it's relevant potentially from my point of view, and same as it's like, you don't hide in the corner when there's challenges or problems, or you're not out there like a giddy school child on the first day of holiday when the market's good. You're looking at it like you're analyzing and putting the effort in, irrelevant of the time. Do you know what I mean? And that's kind of what I get from the 20 Mile March. It's kind of like, a good time, you're analyzing it like you should. And in a shit time, you're analyzing it like you should. Like, yeah. Do you know what I mean? Like you said, pessimistic, optimistic. Yeah, totally. Yeah.
And look, there was a classic example, and I'm not going to bring up the scenario that it was brought to light today for me, but I heard something from a different property business owner who was in property, and their take on it, they basically stopped all of their activities because they didn't believe that there was any point in advertising and doing all of those sorts of things. And I started thinking about it when he was talking about this, and he also had a whiteboard behind him, which I was reading what was on there. And it was more about, their property sales and property prices in their certain areas. And then it started ringing in my head. I just thought, he's focused in the wrong areas, because his belief is that there's no opportunity out there. So basically shut down his business because he believes people won't buy in these sorts of markets. But like you said, you've got to then put on the opposite hat, which goes, okay, because there's many different hats. There's not just the pessimist and the optimist. There's also the facts. And it brought me back to what you were talking about land releases and developments and things of that nature, about how many houses there are going to be to the population of Melbourne, Sydney. And the desire is in times like these that people put on their pessimistic cap or their optimistic cap, and they forget the rest of them. They leave the analysis cap behind, which has been this, their driving force for years and years and years, but they just stop looking.
Yeah. You're dead right. You're dead right. The other ones are too. The analysis, the fact hat. I think what's the other one? The feeling hat. All this sort of thing. Yeah.
I don't know why, but I just think it's fucked.
Yeah. That's the black hat, I think, isn't it? Like the black hat and the Edward. But but I love it. But it really is. It's interesting. From my world, certainly something right now. Two things that are really important. That do sort of, one of six things that sort of give the property market a little bit of a skidge on. Often is population. We've had very positive immigration for a long time, and by and large, Australia's immigration policy is fairly geared towards, hey, if you've got money and you got skills, you can come in. But other than that, get out, So, by and large, those people come to Australia and buy real estate and want to live here and stuff. And the other one is jobs. And it's interesting to sort of see, the commentary in and around, okay, well, jobs, 10% unemployment, like you said, that's actually pretty good compared to the rest of the world. And by and large, I was talking to my team the other day. You go, flip that. We've actually got 90% employment in the country. Just flip it. Just flip the comment and say it the other way, and see how that feels. Try it on. Try the hat on. It
doesn't sell newspapers.
It doesn't sell newspapers, and that's what I'm saying. And then I chatted to a colleague of ours. Like we chat to him all the time. A guy called Dr. Andrew Wilson, and he's saying, well, and he's into stats, and he advises banks and RP Data and Domain, and he was the head stats guy at Domain for 5 years. And he said, well, 50% of those unemployment figures when it comes to real estate weren't ever going to buy real estate anyway, because they were part-time students. Like they were all these workers that didn't qualify for loans anyway. So they're not affecting the actual real estate market. So it's interesting when you kind of like, all right, take a bit of information and then kind of break it down into bits. It's interesting to kind of say, well, yeah, I didn't think of it that way, and then you go, well, then really, what will be the effect, So, nobody ever really knows, but it's interesting to find these interesting opinions based on professional fact, which is, like your contacts. It's just like, wow, okay. Yeah. It's interesting to look at the market in that way.
And look, it's interesting, I think, even more now than ever. Like I've done so many interviews with fund managers. So we're on the topic of opportunity. So I will bring it back to this.
Yes.
But they're still quite scared. Like that, I can just feel it because too few people are willing to make calls on it. Because, and here's the thing: is that after the war, people were optimistic because the war had finished. During the war, obviously nobody could see anywhere through it, right? In the GFC, everyone was fearful, and then all of a sudden, after very little time in Australia, it was a tap on again. But the economy and the markets were sort of basically aligned at that point in time. They were shutting down at the same time, and they were bouncing at the same time. Now we're not seeing it, and you can see that a lot of the fund managers are quite scared because we're dealing with something which they've never had to think about before. Like they've thought about wars, and they've read the history books on wars. They've read the history books on, you know, debt and what debt cycles look like, and demographic cycles and all of these sorts of things. But I think very few of them have actually become an epidemiologist or read too many of those books. And I think that it's what I call young fear. And I spoke about this a number of years ago, because when I first got into finance, I was always a young kid who hung around with all of the old dudes. And I just loved that. People, my previous partner, my late wife, she used to say that you know, you seek out Yoda everywhere you go, and that was kind of how I lived, and it wasn't intentional. I just loved sitting down and listening to people who are far more experienced with far greater knowledge than me just talk.
Yeah.
And back then I had 10 ears and half a mouth. Which is hard to believe, right?
Oh, man, you might be truthing the truth now, Andy.
Yeah, too right. Hard to believe. But one of the things that we almost are out of a generation of right now is a generation of people who have seen adversity, who have seen and felt real effects of significant poverty, significant recessions, significant depressions. Depression is obviously significant by the nature of it. So what we're in a world of now, and so when I was thinking about these investment managers who were getting, you could see it, they were just rattled, is then I thought, oh, how old are they? I mean, some of them are younger than me. And so then I go to guys like Malcolm, who reads a lot of history, and he's got a bit more age and pedigree behind him, and we have conversations. And the difference in perspective is massive. And I think that the difference in perspective basically comes from a way that it's as simple as this. It's like, Andrew, people are people, and people will find a way through things.
100%. We haven't survived. We haven't evolved and survived this long to bloody give up after one little bloody bug that floats around, have we? Like, I mean, at the end of the day, let's face it, you know. Yeah.
And every time we face something, it's always the worst time, and it's always the first time, and it's always never going to get better. You know, this war's never going to end.
Yeah.
You know, this technology is going to destroy the world. You know, the COVID-19 is going to shut the borders for it. But the reality is it's not. And I think from an investment perspective, you put on both hats. It's kind of like, if you have that perspective, put your money in to a degree anyway, because the world's going to blow up. You may as well have a punt as it's going on.
I've always said that to people. If the world ends, who gets
it's game over?
Yeah, it's game over for everyone. So who cares? Who cares? You know. But if it doesn't, fuck, you're up. You know, you're already up. You know. It reminds me of a story, mate, which is really, which I love that you brought up. I really love it, because part of my early career was in the world of outdoor education and outdoor training. And there's a very significant outdoor training company around the world called Outward Bound. You might have even heard of Outward Bound yourself. It was actually started after World War One, and it was in World War One. It was dumbfounding the Army and the Navy and the Air Force why when there were people stranded at sea in little life rafts, that the older men were surviving at sea on the life raft and the young men were dying. It was actually a scientific fact that, you know, a 21-year-old was dying and the 38, 40-year-old was surviving. There is zero scientific reason for the young person to die above the older person. You know, technically it should have been the other way around. And so basically they did some research, and in essence, what it said, their findings were that the older person was like, you know, this because we don't have any fucking water doesn't mean you should give up. And it's a really interesting analogy in what you're saying. Like these young young managers, young property investors, young fund managers, they've never had the shit kicked out of them. You know, they've never been through, you know, these times. And so, you know, it's interesting to hear that from you, because, you know, we have a little bit of a disposition in my world. You know, I say the people you talk to should have an MCA. They should be a mentor. So a mentor to me means they've been there, they've done that, and they've got the scars and the t-shirt to prove it, right? Mm. Now, it doesn't mean you should do what they did, but if they haven't gone through and failed something or fucked it up or whatever, like, you know, that's a cross in my world. Like a coach, MCA, mentor, coach, they should have some skills in and around helping you as an individual build your skills, right? Because if your mental, emotional capacity is limited, but you connect with someone who can get you from a financial position, from your financial position, which you are only capable of because you are limited, and you connect with someone and they can get you in another financial position because of their influence or their assistance, but your mental or emotional capacity doesn't improve with it, I believe you're on a trajectory for a disaster, because your mental and emotional capacity, if it doesn't grow with your financial capacity, will be a fucking train wreck. And then eventually, last but not least, I think it's the least important, but you know, the ATO and ASIC think it's the most important, is an advisor with some licenses and some, you know, some big stick hanging over the head. But I call it an MCA. But, you know, why would you take advice from someone who fucking doesn't have any more money than you? I mean, seriously, you know?
Yeah.
I don't know. Anyway,
I think you take the technical analysis, and you process alternative views, because there's part of getting stuck in your ways, because that's also a trap, because it happened to me, it'll happen to you. Yeah. So there's always got to be that healthy counter. There's always got to be that healthy counter. The coach
part comes in, Andy, because, you know, the coach part is about self-development. And I can't remember where I read it, and I want to fucking track it down, because your wealth needs to be in line with your mental and emotional capacity to handle it. You know what I mean? So, you know, it's an interesting. I'm going to try and track that down. Maybe I've had one too many glasses of wine to really define what I'm talking about.
But I kind of get what you mean, and I completely agree with it. I always used to say, and so this is now the new me coming back out. I always used to say to some of the young bats, I've gone, listen, mate, I've forgotten more than you know. And I've forgotten what you've learned. I've forgotten more than you've learned. But I think that, and I'm not putting myself in the wise category, I'm still very much a student. But I think that the older you get, the wisdom is the part that allows you to not lead with the ego, and it's to kind of be, the older and wiser you get, the more you can digest other opinions that come to you, as long as you're not closed off. And that's the danger. It's about finding those people who have the right balance between being closed off to new ideas and a new world. But yeah, I think I call it the MBA of life.
Life, mate. And, you know, I think for me, that's where the value is, you know, debrief with someone like yourself and the community that we participate in, you know, K2 and beyond, you know, I think, mate, 100%, you know, absolutely. You can get caught up in your own lunchbox, legend in your own lunchbox type of thing. Yeah. And it can be quite myopic, can't it? You know, it's great. Yeah.
But sometimes you've got to trust a bit of instinct as well, and the advice. Like a classic example, which just happened just 2 days ago. I was just personally, it was just about to drop a little bit of money into Macquarie, just a bit of a spec, just because it was just pre-earnings, and I kind of thought, well, I might be able to do an arbitrage as, you know, they release, and maybe do a shared buyback. It was just a bit of a play, and I listened to somebody, and at the time I went, yeah, that sounds pretty reasonable. For whatever reason, I didn't put the trade in. I think I also got busy, but I took the opinion, and it wasn't anybody from Adam. And because it was my own, I'm a little bit more fast and last with some of my own stuff, because your focus is for your clients, which is a danger of being your own stock picker. But then Googled that, because I've had lots of conversations, but I just thought, oh, I want to see him. I want to see this person. Googled him, had a look at him. I'm like, oh, you bastard, bloody young tacker. And then what I do? I look at it, 5% off. I'm just like, now I know it's a long game. There'll be plenty of other opportunities, but I think that's sometimes where you have to. It's a classic example of being able to trust your own wisdom, allow opinions to come to the table, but evaluate them from a perspective of where your knowledge sits, and also other trusted advisors that you have, and don't allow anybody to kind of overrun you, but maintain that objectivity. And to a large extent, common sense will prevail. It's just common sense is not common practice.
No, mate. I think a little bit of time on the track, for a few of us, like you said, as long as it doesn't become you wear a rut in the track, is a good way to roll. So that's where it takes a bit of skill to kind of like reach out to some experience, but also reach out to some inexperience who doesn't have that fear or that stuff holding them back too sometimes, you know what I mean? So, it's an interesting game to play in that sort of space, but
Well, that's why the Lime, and it's a good top and tail from the beginning of the conversation.
Yeah.
Lime was apparently dead and buried well before SARS. It's not bloody SARS. Well before Corona came out.
Yeah.
They were basically they were on their way out, and the pandemic, if anything, probably pushed them to make decisions which potentially prolonged their life to a point where they then got the cash and the vision, because something happened and then the world went, oh, fresh set of glasses, holy smoke, this is an incredible opportunity. And I think that's a great metaphor. The 20 mile march, the old bull, young bull, they're all great metaphors that I think that we should be thinking about now, and where we've got capacity, starting to figure out how you play in that, because there's only so long you can sit in fear. And don't get me wrong, I don't believe that it's 100% rosy out there. I think there's heaps to play out on international trade, geopolitical stuff. But that stuff will, to a degree, sort itself out, and you really can't control or even predict it to a degree. Yeah. You can just say that is going to be there. There will be tension between the US and China. There is going to be harsh talks between China and Australia. And that's kind of like a brick smashing an ant to a large extent. But these things are going to exist. So it's a matter of sort of putting on that hat and going, well, the world's going to keep going on, and we have to keep going on in the world. So what do we do in order to be able to navigate that in the best way possible? And if that's the hat, or that's the glasses that you put on, those are the ones that we need to be putting, both as business, property investors, equity investors, superannuation investors, and for young people out there, I'm kind of going, now is an incredible time that you might want to look at your superannuation funds and start to look at. I'm not saying go out there and just grab a whole lot of stocks, but if you fully believe in Amazons or you fully believe in Apples, it's a great time to be able to find the right super funds so you can actually start to participate in the things that you believe will be the trends of the future, because the chances are you're probably going to be right, at least one or two of them.
Yeah. Well, mate, I like if I had those sorts of concepts and capacities when 15 years ago I fell in love with Apple, and those sorts of, mate, I wish I understood that concept 15 years ago, and a few others, but these days, mate, I think that's like you said, good top and tail for the conversation today. Hopefully, everyone found it interesting or whatever. We didn't really take any questions today, but we sort of, waxed a bit of lyrical on opportunity. Was there anything sort of come through or prepped? I was sort of trying to keep an eye on things, but I couldn't sort of tell with my on my end, Andy. But
I took a different desk today, but if there, for those, and there's still obviously listeners on there, for those people who are listening, flick your questions through because it gives us a chance to research them. Yeah. I think what I'll chat about and what's going to be my focus next week is definitely this release data that's coming from America and also Australia, because America is kicked like a mofo. And I think that, if America comes back, if it does, which I believe it should, but if it does come back, there's going to be some incredible things to chat about there. But I think just reporting back on what's actually come out of the banks and stuff like that. I might even see if I can bend Malcolm's arm and see whether he'll come on and have a bit of a chat with us.
That'd be awesome. Yeah. Let's try to do something like that. Yeah, mate. I'll see if I can line up someone like Dr. Andrew Wilson or someone like that, or like strong arm them a bit. See how we go with a little bit of stats in the property world as well. So we see if we can line that up in the coming weeks.
Well, mate, I reckon we should set each other a challenge. If we can't in COVID times get one of these guys to actually have a wine with us via Zoom on a Friday afternoon, then we'll never get them on a Friday.
Mate, when's it going to happen? Exactly.
All right, done. I'll reach out and see what I can conjure up.
Sweet as, man. All right, brother. Well, as always, fantastic to chat with you, and thank you, everybody. Wine and wisdom on a Friday, maybe wine and wisdom on a Wednesday sounds better, but not as good as a Friday.
It's a bit too early in the week.
Exactly. This is my one drink a week, and I'm enjoying it with Andy. Thanks, brother. All right. Well, thanks everybody. Hopefully it was interesting information. Look forward to next week. And like Andy said, drop us a line on either of our chats, messages, or whatever for questions for the following week. And everybody have a great weekend. You have a great weekend, brother. And
you too,
chat soon. Thanks,
all right.
everyone.
See you, everyone. See you, Jason. See you, mate.
Bye, mate.